Hello and welcome back to MoneyMasterMind. Today we are exploring 10 stock market tips every investor should know. Now let's get started. But first, if you enjoy this content or anything related to investing, be sure to like and subscribe for more videos like this. Now let's get straight into it. An understanding of the stock market is crucial for those seeking to grow their wealth and achieve financial goals. With the ever-changing nature of the market, possessing ample knowledge becomes essential. In this video, we'll explore the 10 essential tips every investor should know to navigate the complexities of the stock market effectively. From understanding risk tolerance to staying informed about market developments, these tips serve as guiding principles for successful investing. By following these insights, you can make informed decisions, mitigate risks, and maximize your chances of long-term financial success in the dynamic world of stock market investing. 1. Assessing risk tolerance is key as it determines your comfort level with potential losses and volatility in your investment portfolio. Risk tolerance is influenced by factors such as financial goals, investment time frame, and personal temperament. Risk tolerance significantly impacts investment decisions, dictating the allocation of assets in a portfolio. Investors with higher risk tolerance may opt for more aggressive investment strategies with a higher potential for returns, such as investing in growth stocks or emerging markets. Conversely, investors with lower risk tolerance may prefer more conservative strategies, such as bonds or dividend-paying stocks, to prioritize capital preservation and stability. Strategies for aligning investments with risk tolerance involve diversification and asset allocation. Diversification spreads investment capital across different asset classes and sectors to reduce portfolio risk. Also, asset allocation involves determining the proportion of assets distributed to various investment categories based on risk tolerance and investment objectives. By employing these strategies, you can construct a portfolio that reflects your risk tolerance while optimizing returns and minimizing downside risk. Understanding risk tolerance aids you in making wise investment decisions consistent with your financial goals and temperament. 2. Thorough research before investing is crucial as it provides you with essential information to make informed decisions. Research allows you to assess the financial health, growth prospects, and competitive positioning of potential investments. By conducting thorough research, you can identify opportunities, evaluate risks, and make investment choices aligned with your objectives. There are several types of research methods you can use, including fundamental analysis, technical analysis, and qualitative analysis. Fundamental analysis involves examining a company's financial statements, earnings reports, and industry trends to assess its intrinsic value. Technical analysis focuses on analyzing historical price movements and market trends to predict future price movement. Qualitative analysis involves evaluating factors such as management quality, industry dynamics, and competitive advantages. You can use various resources for research, including financial statements, company news, and analyst reports. Financial statements such as balance sheets and income statements provide insights into a company's financial performance and position. Company news and press releases offer updates on corporate developments and industry trends. Analyst reports provide professional insights and recommendations on specific stocks or sectors. By leveraging these resources, you can conduct comprehensive research and make well-informed investment decisions. 3. Diversification involves spreading investment capital across a variety of asset classes, sectors, and geographic regions to reduce the overall risk of the portfolio. Instead of putting all your eggs in one basket, diversification ensures that losses from one investment are offset by gains in others, thereby enhancing portfolio stability. Diversification offers several benefits in reducing risk. By investing in different asset classes, you can mitigate the impact of adverse events affecting any single investment. For example, during economic downturns, bonds may provide a buffer against stock market declines. Also, diversification across sectors and geographic regions helps reduce exposure to specific industry risks and geopolitical factors. Strategies for achieving diversification include asset allocation and sector allocation. Asset allocation involves determining the proportion of assets allocated to different asset classes, such as stocks, bonds, and cash equivalents based on investment objectives and risk tolerance. Sector allocation involves diversifying investments across various industries to minimize sector-specific risks. You can achieve diversification through mutual funds, exchange-traded funds, or individually selecting a mix of investments across different asset classes and sectors. By implementing diversification strategies, you can build resilient portfolios that can withstand market fluctuations and enhance long-term returns while reducing overall portfolio risk. 4. Investing for the long term offers several advantages, including the potential for higher returns, reduced transaction costs, and minimized emotional reactions to short-term market fluctuations. Long-term investors can capitalize on the inherent growth potential of the stock market and benefit from the compounding effect of reinvested dividends over time. The power of compounding returns over time is a key advantage of long-term investing. Compounding allows you to earn returns not only on your initial investment, but also on the accumulated returns from previous periods. Over time, compounding can significantly boost investment returns, accelerating wealth accumulation and helping investors achieve their financial goals. Avoiding the pitfalls of short-term speculation is essential for long-term investors. Short-term speculation often leads to impulsive buying and selling behavior driven by market noise and emotional reactions. By maintaining a long-term investment horizon, you can avoid the stress and uncertainty associated with short-term market fluctuations and focus on the fundamental value of your investments. By adopting a long-term investment approach, you can exploit the power of compounding returns, minimize transaction costs, and sidestep the pitfalls of short-term speculation. Investing for the long term allows you to capitalize on the wealth-building potential of the stock market and achieve financial success over time. 5. Staying updated on market developments is crucial for you to make informed decisions and adapt to changing market conditions. By staying informed, you can identify emerging trends, anticipate potential risks, and capitalize on investment opportunities. Market developments can include economic indicators, geopolitical events, and company-specific news that may impact stock prices and market sentiment. Utilizing financial news sources and market analysis provides you with valuable insights into market dynamics and trends. Financial news outlets such as Bloomberg, CNBC, and Financial Times offer real-time updates on market developments, expert analysis, and commentary on economic trends. Also, market analysis platforms and research reports provide in-depth analysis of specific sectors, companies, and investment opportunities, helping you make informed investment decisions. Monitoring company performance and industry trends allows you to assess the health and growth prospects of their investments. By tracking key performance indicators, financial metrics, and industry benchmarks, you can gauge the profitability and competitive positioning of companies in your portfolio. Also, staying informed of industry trends, technological advancements, and regulatory changes helps you anticipate market shifts and position your portfolios accordingly. By staying informed about market developments, utilizing financial news sources and market analysis, and monitoring company performance and industry trends, you can make informed decisions and stay ahead of the curve in the dynamic world of stock market investing. 6. Market timing refers to the practice of attempting to predict future market movements in order to buy or sell assets at the most opportune times. You may try to time the market by analyzing past price movements, economic indicators, or other factors to determine when to enter or exit the market. Market timing carries significant risks, as accurately predicting short-term market movements is notoriously difficult. Investors who attempt to time the market may miss out on potential gains if they exit the market during periods of growth or re-enter at higher prices after waiting on the sidelines. Also, frequent trading can increase transaction costs and taxes, diminishing investment returns over time. Instead of trying to time the market, you can benefit from adopting a consistent investment approach based on your long-term financial goals and risk tolerance. A consistent investment approach involves maintaining a diversified portfolio, adhering to a disciplined investment strategy, and staying focused on the fundamentals of investing. By focusing on long-term trends and avoiding the temptation to react to short-term market fluctuations, you can achieve more predictable investment outcomes and build wealth steadily over time. By avoiding the pitfalls of market timing and embracing a consistent investment approach, you can reduce risk, minimize costs, and increase your chances of long-term investment success in the stock market. 7. Emotions play a significant role in investment decisions, often leading you to make irrational choices driven by fear, greed, or overconfidence. Emotional reactions to market fluctuations can cloud judgment, causing you to buy or sell assets based on short-term fluctuations rather than long-term fundamentals. Recognizing the impact of emotions on investment decisions is key for maintaining a disciplined and rational approach to investing. Strategies for managing emotions include maintaining discipline and focus. By establishing clear investment goals, adhering to a well-defined investment plan, and avoiding impulsive decisions, you can mitigate the influence of emotions on your investment decisions. Also, maintaining a long-term perspective and focusing on the fundamental value of investments can help you stay grounded and avoid making emotionally driven decisions. Avoiding impulsive buying and selling behavior is essential for keeping emotions in check. You should resist the urge to react hastily to market fluctuations and instead focus on the underlying reasons for your investment decisions. Implementing predefined entry and exit criteria, setting stop-loss orders, and regularly reviewing investment portfolios can help you stay disciplined and avoid making emotional investment decisions that may undermine long-term investment success. By keeping emotions in check, you can make more rational and informed investment decisions, reduce the likelihood of costly mistakes, and increase your chances of achieving your long-term financial goals in the stock market. 8. Understanding investment returns and volatility is essential for setting realistic expectations. While the stock market has historically provided attractive long-term returns, it is also subject to short-term volatility and fluctuations. You should be prepared for periods of market downturns and understand that investment returns are not guaranteed and may vary over time. Setting achievable investment goals involves aligning expectations with investment objectives, time horizon, and risk tolerance. You should establish clear and realistic goals such as saving for retirement, funding education expenses, or achieving a specific rate of return. By setting achievable goals, you can avoid disappointment and stay focused on your long-term financial objectives. Managing expectations in line with market realities requires accepting the inherent uncertainties and risks of investing in the stock market. While it's natural to desire high returns, you should adjust your expectations and recognize that market conditions, economic factors, and unforeseen events may impact investment outcomes. By maintaining a balanced perspective and adjusting expectations as needed, you can navigate market changes and maintain a disciplined investment approach. By having realistic expectations, you can avoid chasing unrealistic returns, reduce the likelihood of making emotional investment decisions, and increase your ability to stay committed to your long-term investment strategy. Ultimately, having realistic expectations sets the foundation for a successful and sustainable investment journey in the stock market. 9. Portfolio management is essential for you to track performance, assess risk, and ensure that your investments remain aligned with your financial goals. Regularly reviewing portfolio holdings allows you to identify underperforming assets, rebalance allocations, and make strategic adjustments as needed. Rebalancing strategies involve periodically adjusting portfolio allocations to maintain desired asset class weights and risk levels. This may involve selling assets that have become overvalued and reinvesting the proceeds into undervalued asset classes. By rebalancing, you can realign your portfolios to reflect changes in market conditions and maintain optimal diversification. Adjusting investment strategy in response to changing market conditions is critical for adapting to economic trends, geopolitical events, and shifts in the market. This may involve shifting allocations between asset classes, sectors, or geographic regions to capitalize on emerging opportunities or mitigate risks. Also, you should reassess your investment goals, risk tolerance, and time horizon periodically to ensure that your investment strategy remains aligned with your changing financial needs. By continuously reviewing and adjusting your portfolios, you can optimize returns, manage risk, and adapt to changing market dynamics. Regular portfolio monitoring enables you to stay proactive, capitalize on investment opportunities, and navigate challenges effectively in pursuit of your long-term financial objectives. 10. Consulting with a financial advisor offers several benefits for you, including personalized guidance, expertise, and access to professional investment management services. Financial advisors can help you navigate complex financial decisions, develop tailored investment strategies, and achieve your long-term financial goals with confidence. Financial advisors offer a range of services to meet the diverse needs of investors. These services may include portfolio management, where advisors oversee and manage investments on behalf of clients, ensuring alignment with their objectives and risk tolerance. Also, financial advisors provide comprehensive financial planning services, covering areas such as retirement planning, tax planning, estate planning, and risk management. Advisors also offer investment advice, recommending suitable investment opportunities and helping clients make informed decisions in line with their financial objectives. Finding a reputable financial advisor involves conducting thorough research and due diligence. You should seek advisors who are licensed, registered with regulatory authorities, and adhere to legal obligations, prioritizing clients' best interests. Also, you should consider factors such as experience, qualifications, reputation, and fee structure when selecting a financial advisor. Referrals from trusted sources such as friends, family, or professional networks can also help you identify reputable advisors who can provide valuable guidance and support in achieving your financial goals. By considering seeking professional advice from a qualified financial advisor, you can benefit from personalized guidance, expert insights, and comprehensive financial planning services to navigate the complexities of investing and achieve financial success. In summary, the 10 essential stock market tips discussed in this video provide you with valuable insights and strategies for navigating the complexities of investing successfully. From understanding risk tolerance to staying informed and seeking professional advice, these tips serve as guiding principles for achieving long-term financial success in the stock market. Encouragement is extended to you to apply these tips in your investment journey. By incorporating these strategies into your investment approach, you can enhance your decision-making, manage risk effectively, and work towards achieving your financial goals with confidence. Embracing these principles can allow you to navigate market charges and capitalize on investment opportunities while minimizing potential pitfalls. It's crucial to emphasize the importance of ongoing learning and adaptation in the dynamic world of investing. Markets evolve, economic conditions change, and new opportunities emerge. You should remain vigilant, stay informed about market developments, and continuously refine your investment strategies to stay ahead of the curve. By embracing a mindset of lifelong learning and adaptation, you can position yourself for success in the ever-changing landscape of the stock market. In summary, by applying the 10 essential stock market tips, you can build resilient portfolios, mitigate risk, and work towards achieving your financial aspirations in the dynamic and rewarding world of investing. Thanks for watching Money Mastermind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.